Hello and welcome to The Explainer. Today, we're diving into a topic that's absolutely vital for every business owner and tax professional: how to correctly claim tax deductions for your employee welfare contributions under the new Income Tax Act 2025. Look, as an employer, you're already investing in your team's future. Provident funds, gratuity, you name it. And that's fantastic. But the real question is, are you getting the full tax benefit you're entitled to? This is exactly where Section 29 comes in. And trust me, getting the details right here is a game changer.
So, here's our game plan for today. We'll start with a quick introduction, then we'll get into the legal framework of Section 29 itself. After that, we'll break down the different deductions, look at a real-world example, cover some very important compliance issues, and then wrap it all up with the key takeaways. Okay, first things first, let's just set the stage a little. We all know that contributions to employee welfare can be a pretty significant expense. But the good news is, the tax law actually wants to support you for investing in your people. You see, the new Income Tax Act of 2025 has very clear rules that let businesses claim these welfare expenses as deductions. This effectively turns what could be just a cost into a smart, tax-efficient investment. And the absolute cornerstone of this whole framework, well, that's Section 29. All right, let's get into the nitty-gritty of the law itself. We're talking about Section 29. This is the section that really governs the most common and, frankly, the most significant welfare contributions that you're going to make as an employer. So what's the big idea behind Section 29? Well, at its heart, it's really an incentive for you, the employer. It's pretty straightforward. When you put money into specific, approved funds for your employees' Social Security, the law lets you deduct those amounts from your business income. And what does that mean? It means a lower tax bill. Simple as that. Now let's break down exactly what kinds of contributions actually qualify here. You can't just claim everything. The law is very specific about which funds are eligible for this deduction. So as you can see here, Section 29 spells it out pretty clearly. We're talking about contributions to a recognized provident fund, an approved superannuation fund, and an approved gratuity fund. Now, what's the one condition that's absolutely non-negotiable? The fund must be officially recognized or approved. Same logic applies to pension schemes. They have to be officially notified by the central government to qualify. But what about other welfare schemes? Things like medical aid or maybe some recreational facilities for your staff. Well, for those, there's a different route. These fall under Section 11.3 and Schedule 7. The fund has to be a proper trust, and you'll need to get a specific approval from the tax department. You do this by filing Form 180, which is part of the new Income Tax Rules 2026. And one key thing to remember here, this approval isn't forever. It's only valid for a maximum of 3 tax years at a time. Okay, theory is all well and good, but let's see how this actually works with some real numbers. I think a simple example will make the financial benefit crystal clear. All right, check this out. Let's say ABC Corp contributes 5 lakh rupees to its approved gratuity fund. Now, because that fund is approved and they made the payment during the tax year, the company gets to deduct the entire 5 lakh rupees when they calculate their business income. It's a direct, powerful way to bring down the company's taxable profit. Now, please pay close attention because this might be the most important part of our whole discussion. Claiming the deduction is one thing, but making sure it doesn't get disallowed is everything. And there's one specific trap where so many people go wrong. Okay, here is the critical difference you have to understand. Your own contribution, the employer's share, is deductible in the year you actually pay it. That's pretty simple. But the employee's contribution, the money you deduct from their salary, has a very strict deadline. You absolutely must deposit that amount into the fund by the statutory due date. Why? Because that money isn't really yours. It belongs to the employee. The law is very strict to make sure it gets to their account on time. If you are even 1 day late, boom, you lose the deduction for that employee portion. This is, without a doubt, one of the most common and costly mistakes taxpayers make. So, to make sure you stay on the right side of the law, here is your essential checklist. Number 1, always verify that the fund is officially approved or recognized. Number 2, remember, these deductions are on a payment basis, so make sure the money is actually transferred within the tax year. 3, and this is the big one, be religious about meeting the due dates for the employee's share. And finally, number 4, maintain perfect records. If you're ever audited, your documentation, the trust deeds, approval letters, payment records, that's going to be your best defense. All right, let's bring it all home now and quickly recap the most important points we've covered today. So, to sum it all up, Section 29 is your key for deducting contributions to the major employee welfare funds. Remember, the fund's official status is everything. No approval means no deduction. Please, watch out for that deadline on the employee's share. It's the most common reason for disallowance. And lastly, always keep detailed and organized records to back up every single claim you make. So, I'll leave you with this thought to take away. Understanding the rules is just step one. The next and more important step is to think strategically. How can you now design or perhaps fine-tune your employee benefit programs to not only keep your team happy, but also to do it in the most tax-efficient way possible? Thank you so much for watching. If you found this explainer useful, we'd really appreciate it if you'd hit the like button, subscribe to our channel, and share this with anyone else you think could benefit from it. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.